It is time now for today's morning brief. We're keeping the tech theme going with a close eye on this theme of artificial intelligence. Many companies are playing into the AI hype, and with that comes the dual tone on the matter, between it being a punchline of sorts, but also having a real potential impact. Joining us here now with more on what might come next for tech writ large in the broader markets amid the AI craze is Shaniel Ramjee, Pictet Annual Asset Management Senior Investment Manager. Thank you so much for being here.
Thank you for having me.
So obviously this is a big focus for investors right now. As we were just talking about with regard to Meta, they of course talked about artificial intelligence. Some of it is the new flavor, some of it's the old flavor, but that seems to be where a lot of investment is going right now. How much should investors be chasing that when it comes to big tech?
I think it's always interesting to think about where growth can take us over the next few years, but the here and now is that what we know is the computational requirement for any of these AI capabilities is large, much larger than, let's say, a Google search would cost in terms of that computational requirement. So we think about it as investors, the picks and shovels. What do we need to even get to those use cases? So it is those semiconductors, it is those areas in that supply chain that will help these businesses around the world even produce those AI capabilities. So that's what's going to be the first starting point for us before we even get to how can we use this in real lives, because the applications for AI are probably not even realized by many companies today.
What is an acceptable timeline, or what is perhaps even a benchmark timeline that investors should be keeping in the back of their heads when they hear all of these claims, when they hear all the ambitious goals that companies are setting forth around AI? What can investors hold them to in terms of a timeline for that to actually be realized and show up through the financials of these companies?
I always go back to the old saying where we overestimate what can happen over 2 years, but underestimate what can happen over 10. And I think this AI development is probably something like that. What we probably have to realize is that this efficiency that all these companies are trying to achieve, part of that will come through automation. So part of that will come through various levels of AI. And I think what we need to think about is, what does that mean as it progresses? It will start small. It will start in areas where the low-hanging fruit can be easily achieved, and then get to the areas where we see as in our minds the big thematic AI. But I think that's going to take a longer time. We don't have that computation ability, and I don't think companies have, especially at the near term, the ability to invest so much as margins get squeezed over the next 12 months. We look to see which companies are able to make those CapEx investments in these efficiency gains. And I think one thing investors will be looking at is where companies are able to grow their companies instead of just doing cost cutting.
One of the themes we've been talking about this year is how reliant the major averages have been on the tech trade, on the large cap tech trade. We were just showing large cap tech, it's all going up. So it's working still for right now. Should investors be leaning into that? Is tech going to continue to sort of carry the averages higher as we head throughout earnings season, especially if we keep getting numbers like this?
It's all about profitability. So are these tech companies able to be more profitable than the broader market? And by and large, I think what we've seen is that they have been able to be that profitability center. They don't have a lot of leverage on their balance sheets. And again, going into a slower economic environment, that's useful. Now, what we would say is that they're not exactly the cheapest stocks out there, not the cheapest companies out there. So they need to deliver on these earnings. They need to deliver on their profitability. And so far, what we've seen this week is that they have been able to deliver on that. So that's what the market and investors will be gauging as we go forward. But as you mentioned earlier, there are other companies around the world, not just tech, that are delivering. And we see some signs in the cyclical sectors. So the industrials are one of the areas where we can see some demand coming through. Some of the policies like the IRA, the CHIPS Act, causing much more investment in tangible assets. And we see some of those numbers being reflected in the industrials.
When we think about more broadly and kind of the larger narrative that we've heard about where in the world there is going to be still growth, even if there is slowing growth or decelerative growth in the U.S. here. China, India have been two of those economies that have been looked at, whether it's the IMF or companies that are announcing their ambitions about how they want to grow in those regions. when you think about how to play China right now, where is even a starting point that an investor can think about?
So at the moment, we saw the industrial production numbers in China just come out. They were not as strong as maybe people hoped. And I think that's partly due to the property sector still being quite weak. But the export numbers in China tell us that the manufacturing economy is still very strong. So how do we think about investing in China? We think proxy trades a lot of the time are interesting. So Caterpillar, for example, will have some exposure to that Chinese resurgence as it happens. But we think the Chinese consumer is going to be driving the growth in China. And we like the premium brands, the luxury companies in Europe. They've shown really strong sales coming into that reopening of China. And the travel that's occurring through Asia means that brands, whether they're apparel companies, whether they're cosmetics companies, they're showing really good revenue growth from that increase in travel. And even so, we see it in the airline numbers. The better numbers coming out there. So we think it's about global companies that are able to get hold of that Chinese consumer spend.
Yeah, obviously LVMH has been killing it. Just quickly, Shaniel, one of the things that you said in your notes that was intriguing to me is that what investors sort of have to benchmark against right now is the yield on cash, right? Which obviously has gone up a lot, which is sort of a different way of thinking than we've had to think for a long time. Is it harder then? Is that a hard benchmark to beat right now, that yield?
Absolutely. I think that yield on cash, if we're looking at money market funds today, not the banks, obviously we have that problem, but the money market funds going close to 5% now, that's a big draw to a lot of investors. We have to remember that inflation is still around 5%. So in real terms, we're just breaking even, right? So for investors and long-term investors, you want to think about growing your capital, growing your savings in real terms. How are we going to do that? And we do think that there is a place for income, there is a place for that higher yield, and it does give us that cushion. But you will have to think about more cyclical investments, being equities, to give you that real return. And we caution against being too defensive for too long, because you won't achieve that real return over time.
Yeah, great point. Thanks so much, Shaniel. Good to meet you. Good to have you here in studio. Shaniel Ramjee is Pictet Asset Management Senior Investment Manager.